Hi, this is Robin Tull with Tull Financial Group. We are coming to you again for a Financial Friday that we've been doing for the last few months. I'm with today Ellen Anderson, our Director of Investments. And we just want to talk a little bit about some of the questions that we're getting. The first thing is that I wrote a recent piece called Disruption. And when you think of disruptors in the world, you think of things that I've gone through would be the 9/11, the Great Recession, things like that that you didn't expect. The question that we're getting now is the election coming up a disruptor? And it really isn't, because we know that it comes every 4 years. So the questions that have been coming up is saying, what should I be doing about that? And so a few weeks ago, I went into Ellen's office and I said, hey, let's do some research on past elections and see what other sources are doing. So Ellen, what came out of that research?
So we looked at BlackRock, Vanguard, JP Morgan, a few other websites, just to look at, okay, what does the history look like? What does history tell us? And what we found, and we have a graph up here on the slides, is stocks have continued higher regardless of presidential party. So that means whether it's the blue party or the red party that's won, the stock market has continued higher. And what that is too is corporations have adapted. They adapt to policy change. They adapt to economic change. The other thing we saw was in election years, historically, volatility has been higher and returns have been lower. But what contributes to that is there's all of these election years that had dramatic economic events. So you had 2008 with the Great Recession, like Robin mentioned, in 2000. With technology bubble burst, so that kind of skews returns. And then this year, looking forward, we had a pandemic and a recession, so it'll definitely be interesting. Yes,
that's true. Yeah, and I think when you look at investing, the thing that the principle that we always share is you set your asset allocation prior to any disruption or prior to any event. That way, you don't simply say, oh, I got to get out, I can't handle this. I think, people asking what questions are you getting is should I sit on the sideline for a little while? And what's usually the best regarding that type of question that comes to you?
It's a tough one because every investor is different. It definitely depends on your comfort level, but what we advise most and what I've heard you advise clients on is stay long-term focused. If you believe in the American economy and the global economy, which we do, you have to let that drive your long-term. That's what drives long-term results, and that's what should drive your long-term asset allocation. You don't know when to get back in.
You don't, and I think that's the issue. We sometimes use the principle of the lifeguard at a pool, and you may actually pick a good time to get out of the pool, get out of the market. But the difficulty is that second decision is when to get back. And so many people miss out on that. And that can be 2-5%, and it can really affect your long-term performance. And so those are the things that we look at. So I think that what we always try to say is whoever's in office, we're going to work to make money and minimize the losses from that standpoint. So I think that's a good principle to have, and just say, okay, 12 months from now, do we expect the market to be higher? And that would be, yes, we do, especially coming out of recovery.
Yeah, that's good.
Well, we hope this is helpful as it relates to the election coming up. Please call us, email us if you have any other topics you'd like us to discuss at this time. Have a great day.